On June 18, 2020, the auditors at Ernst & Young informed the Wirecard Management Board that two Philippine financial institutions, BDO Unibank and the Bank of the Philippine Islands, had confirmed in writing that no trustee accounts bearing Wirecard funds had ever existed at their institutions. The confirmation letters that Wirecard had previously supplied to EY, purporting to verify the existence of approximately $1.9 billion in escrow cash, were declared by both banks to be spurious. Within 24 hours, Wirecard AG disclosed to the market that the cash balances in question could not be located. Within a week, Chief Executive Officer Marcus Brown had resigned, and Chief Operating Officer Jan Marsalek, according to Austrian aviation records subsequently published, had boarded a private flight from Bad Vöslau Aerodrome bound for Minsk. The structural question this episode answers is how a publicly listed member of the DAX 30 sustained, for approximately a decade, an audit-confirmed cash balance that the record now establishes never existed. The mechanism at the center of the Wirecard fraud was the third-party acquirer, or TPA, arrangement. To understand how it was distorted, the legitimate function must first be established. Wirecard operated as a payment processor. When a consumer used a credit card at a merchant integrated with Wirecard's platform, Wirecard's systems routed the transaction through the card networks, settled funds with the acquiring bank, and remitted net proceeds to the merchant after deducting interchange fees, scheme fees, and Wirecard's own processing margin. This is a regulated activity. In most jurisdictions, the processor must hold a payment institution license, must maintain segregation of merchant funds, and must satisfy ongoing capital and conduct requirements from its national financial supervisor. In Germany, that supervisor was BaFin. A third-party acquirer arrangement arises when the payment processor does not itself hold the requisite license in a particular jurisdiction, or does not wish to onboard certain categories of merchant directly. In such cases, the processor contracts with a locally licensed acquirer, which formally onboards the merchant, holds the relationship with the card schemes for that merchant, and processes the transactions. The third-party acquirer collects merchant fees, remits the merchant share, and pays a commission to the technology partner, in this case Wirecard, for routing, risk management, and software services. This is a real business. It exists lawfully across the payments industry. The reasons a processor uses TPAs include licensing geography, risk appetite around so-called high-risk merchant categories such as online gambling, adult content, and certain forms of nutraceutical sales, and operational efficiency in markets where direct onboarding is not commercially attractive. Wirecard's TPE business, according to the company's own disclosures across the period from approximately 2011 to 2020, was concentrated through a small number of partners located in Asia. The principal counterparties, as identified in subsequent reporting by KPMG in its special investigation and by the Bundestag Inquiry Committee, included an entity in Dubai called Al Alam Solutions, an entity in the Philippines called Pay Easy Solutions, and an entity in Singapore called Senjo Group. Through these three partners, Wirecard reported, a substantial portion of its consolidated EBITDA was generated. The accounting treatment was as follows. Because Wirecard did not hold the merchant relationship directly in the TPA model, it did not recognize gross transaction volume as revenue. Instead, it recognized commission income net of the amounts passing through to the acquirer. However, Because Wirecard contractually retained risk exposure on certain elements of the merchant flow, chargebacks, refunds, and merchant default, it claimed the right to hold a portion of the processed funds in escrow, ostensibly to satisfy those contingent liabilities. These escrow balances were held, the company represented, in trustee accounts at banks in the jurisdictions of the third-party acquirers. The trustee was a Philippine attorney for the bulk of the balances. The banks were initially the Bank of Sino-Pacific Mauritius and OCBC Singapore, then Citadel Trust, and ultimately, as of the 2019 fiscal year, BDO Unibank and the Bank of the Philippine Islands. These trustee balances were classified on Wirecard's consolidated balance sheet as cash and cash equivalents. By 2019, the reported total stood at approximately $1.9 billion, representing the majority of the group's reported liquidity. The legitimate version of this structure would have produced verifiable cash, held by a real trustee at a real bank, backing real transaction flow, generated by real merchants, processed by real acquirers. The structural distortion, as the record now establishes, was that the transaction flow at the TPA partners was substantially fabricated. The trustee balances did not exist, and the cash on Wirecard's balance sheet was a number unconnected to any underlying asset. The architecture by which this was sustained operated in three interlocking layers. The first layer was the partner entities themselves. Al Alam Solutions, based in Dubai, was reported by Wirecard to process payments for an extensive book of online merchants, generating by 2016 more than half of the group's reported profit. When the Financial Times conducted on-site reporting at Al Alam's registered address in 2019, the journalists documented a small office staff whose stated client list, when contacted, in many cases denied any commercial relationship with Al Alam or with Wirecard. Several of the listed merchants were defunct. Several others did not exist. The KPMG special investigation, commissioned by the Wirecard Supervisory Board and published in April 2020, concluded that for the TPA business between 2016 and 2018, KPMG was unable to obtain sufficient documentation to verify that the underlying revenue had been generated. The second layer was the trustee structure. From approximately 2015 onward, the funds purportedly accumulating in the TPA business were represented to be held by a Philippine trustee, who in turn maintained accounts at named banks on Wirecard's behalf. The trustee, an individual attorney based in Manila, controlled the documentation that confirmed the balances. Audit confirmations to EY in respect of these balances were channeled through the trustee, and ultimately, in the final reporting years, through what were represented as direct confirmations from the partner banks. The third layer was the audit confirmation process. This is the layer at which the fabrication was most direct. The record of the Munich prosecutor's investigation, as summarized in the indictment subsequently filed against Marcus Brown and others, establishes that confirmation letters supplied to EY purporting to come from BDO Unibank and the Bank of the Philippine Islands were not authentic communications from those institutions. When the auditors, in the spring of 2020, sought to bypass the trustee and confirm directly with the banks responded that the accounts referenced did not exist. Working from the KPMG report, the Bundestag inquiry record, and the Munich indictment, the operational sequence can be reconstructed in approximate terms as follows. Step 1. Wirecard reported processing volumes through the TPA partners that were, in material part, fictitious. The volumes corresponded to merchants that either did not exist, were not in fact customers of the partners, or generated transaction flow at levels far below what Wirecard reported. Step 2. Against this fabricated volume, Wirecard recognized commission revenue and recorded receivables and cash purportedly held in escrow. The accounting entries flowed through normal channels into the consolidated statements. Step 3. The escrow balances, growing year by year as the fabricated volume grew, were represented to be held in trustee accounts. The trustees' records, controlled at the relationship level by a single Philippine attorney for an extended period, served as the documentary basis for the asset. Step 4. Audit confirmations were obtained through the trustee. EY for several years accepted confirmations that did not originate directly from the banks. When the audit firm did not pursue direct independent confirmation from the named banks, the fabrication remained undetected. Step 5. The cash, which existed nowhere, was reported as the principal liquidity of a DAX 30 company. The scale grew over time. The KPMG report identifies that the trustee-held balances were approximately $1.0 billion as of 2017, approximately $1.6 billion as of 2018, and approximately $1.9 billion as of 2019. This is the figure that the June 18, 2020 disclosure identified as missing. The cash represented on the balance sheet was the load-bearing component of Wirecard's equity story. The company's market capitalization at peak exceeded $24 billion. Its inclusion in the DAX 30 in September 2018, replacing Commerzbank, was a function of its market value and trading liquidity, both of which were supported by the reported financials. The reported financials were supported by the cash. The cash was supported by the trustee. The trustee was supported by confirmation letters. And the confirmation letters, the record now establishes, were fabricated. The corporate structure facilitating this architecture extended beyond the named partners. Wirecard Bank AG, a wholly owned subsidiary, held a banking license in Germany. The existence of a regulated banking entity within the group provided a presumption of legitimacy that extended outward to the rest of the consolidated reporting. Wirecard Bank AG was supervised by BaFin. The parent, Wirecard AG, was treated by BaFin as a technology holding company rather than as a financial institution subject to consolidated banking supervision. This jurisdictional distinction will return in the detection failure analysis. Two further structural features of the architecture are worth establishing on the record. First, the TPA business was geographically remote from the auditors, the regulators, and the analysts who covered the company. The named counterparties operated in Dubai, the Philippines, and Singapore. The merchant flow was, on paper, distributed across hundreds of small online businesses in jurisdictions ranging from Latin America to Southeast Asia. Physical verification was operationally difficult. The record establishes that EY's audit procedures for the relevant period did not include independent on-site verification of the TPA partner businesses or of the underlying merchant flow at the scale that the reported figures implied. Second, Wirecard engaged extensively in acquisitions during the period in which the TPA balances were growing. The company acquired Indian payments businesses, in particular the Hermes Group, at consideration that was subsequently challenged as significantly above fair value. These transactions, as KPMG and subsequent commentators have observed, were structurally consistent with a mechanism for moving fabricated balance sheet cash into acquired goodwill, where it could be impaired or absorbed over time without producing a cash outflow that would expose the underlying gap. The record does not establish a definitive finding on every acquisition, but the pattern of large outbound transactions from a company that, on the available evidence, did not in fact possess the cash it claimed is documented in the Bundestag inquiry materials. The detection failure is the section of this case that bears the most extended structural analysis, because the fraud was, in significant respects, reported publicly while it was ongoing, and the reports were not acted upon. 4 gatekeepers can be identified: the external auditor, EY, the National Financial Supervisor, BaFin, the sell-side analyst community, and the financial press. The detection failure was not uniform across these 4. The financial press, in particular the Financial Times, published substantive reporting beginning in 2015 that identified specific irregularities in Wirecard's accounting. The other 3 gatekeepers, in varying ways, failed to act on what was being established in public. EY served as Wirecard's external auditor for the entire period in which the TPA fabrication grew to its final scale. The audit firm issued unqualified opinions on Wirecard's consolidated financial statements every year through fiscal 2018. The 2019 audit was the one in which EY ultimately sought direct confirmation from BDO and BPI and discovered that the accounts did not exist. The structural question for the audit profession is why direct confirmation was not pursued earlier. The KPMG Special Investigation Report, while not an audit of EY, identified that the standard of evidence relied upon for the TPA escrow balances did not meet what would ordinarily be expected for cash balances of that materiality. Cash is, in the hierarchy of audit assertions, among the most straightforwardly verifiable assets. The standard procedure for cash held at a third-party bank is direct confirmation from the bank on the bank's letterhead, returned directly to the auditor through a controlled channel that does not pass through the client or any party related to the client. The record establishes that for an extended period, the confirmations relied upon by EY were channeled through the Philippine trustee. The trustee was, structurally, a related party to the asset being confirmed, in the sense that the trustee's role in the arrangement created an interest in the confirmation's acceptance. The Wirecard Supervisory Board, in commissioning KPMG, sought independent verification precisely because the audit confirmations had become a point of contention with the company's critics. KPMG, in turn, was unable to verify the balances. The structural finding is that the audit procedure that would have detected the fraud at any point in the preceding decade was direct independent confirmation from the named banks through a channel not controlled by the trustee. That procedure was implemented in 2020. It produced disclosure of the fraud within days. BaFin, the German financial supervisor, occupies a more complicated position in the detection record. Wirecard AG as a whole was not regulated as a financial institution by BaFin. Only Wirecard Bank AG, the subsidiary, was so regulated. The consequence was that BaFin's supervisory authority over the consolidated group, including the TPA business, was structurally limited. However, BaFin did take supervisory action during the period. The action it took was not against Wirecard. In February 2019, following Financial Times reporting that alleged accounting irregularities at Wirecard's Singapore operations, BaFin imposed a 2-month prohibition on short-selling Wirecard shares, citing market integrity concerns. The supervisor opened investigations into Financial Times journalists for suspected market manipulation in coordination with short sellers. The Bundestag Inquiry Committee subsequently found that BaFin's supervisory response had been structured around protecting Wirecard from what it characterized as attacks, rather than investigating the substance of the allegations being raised. The structural failure at BaFin was, in part, a question of jurisdictional definition. Because Wirecard AG was classified as a technology company rather than a financial holding company, the entity through which the fabricated balances flowed was not within BaFin's supervisory perimeter for consolidated financial reporting. The Bundestag inquiry record establishes that this classification was reviewed and maintained internally despite the growing public allegations. The sell-side analyst community covered Wirecard extensively. The company carried buy ratings from major German and international investment banks through most of the period in question. The analyst reports treated the reported financials as the primary input, projected continued growth in the TPA business, and applied valuation multiples consistent with high-growth payments technology peers. The detection question for the analyst function is whether the unusual concentration of profit in opaque Asian partners with no observable customer-level disclosure ought to have prompted material qualification of the published research. The record establishes that, with limited exceptions, it did not. The Financial Times, beginning with reporting by Dan McCrum and colleagues in 2015 and continuing through the so-called House of Wirecard series in 2019, published detailed allegations regarding the TPA business, the partner entities, and the questionable nature of the reported transaction volumes. The reporting included documentation that purported customers of Al-Alam denied any business relationship with that entity. The reporting was met, as noted, with regulatory action against the journalists rather than against the company. The structural observation here is that the detection function in the Wirecard case was performed by short sellers and by investigative journalists, not by the institutions formally constituted to perform it. The auditor accepted confirmations from a controlled channel. The supervisor classified the holding company outside its perimeter and took action against the parties raising allegations. The analyst community accepted the reported figures. The detection that occurred in the financial press and in short-selling research notes. The action on that detection did not occur until June 2020. For detection to have occurred earlier through the formal verification chain, the following would have had to be true. First, EY would have had to require direct independent confirmation from the named banks through channels not involving the trustee, beginning at the earliest year in which the trustee held balances became material to the audit. Second, BaFin would have had to assert consolidated supervisory authority over Wirecard AG, or to have referred the consolidated financial reporting concerns to the Financial Reporting Enforcement Panel, which in Germany had primary responsibility for listed company reporting review, with greater urgency. Third, the analyst community would have had to apply skepticism to reported figures that lacked corroborating customer-level disclosure. None of these conditions was satisfied until the fraud was already collapsing under its own weight. The unravelling proceeded through a specific sequence that the public record establishes with precision. In October 2019, Wirecard's supervisory board, Under sustained pressure from the Financial Times reporting and from institutional shareholders, commissioned KPMG to perform a special investigation into the allegations. The mandate was to review the TPA business, the third-party partner relationships, and the underlying transaction volumes, and to provide independent verification of the reported figures for the years 2016 through 2018. The KPMG Special Investigation Report was delivered on April 28, 2020. The report's conclusions were carefully worded. KPMG stated that it had been unable, due to limitations in the documentation provided and the cooperation of certain third parties, to verify that the TPA business had generated the revenues reported. KPMG did not affirmatively conclude that the revenues were fabricated. It concluded that the evidence necessary to verify them had not been provided. The market response to the KPMG report was severe, but not yet terminal. Wirecard shares declined materially. Management maintained that the report's findings reflected limitations of access rather than substantive accounting irregularity. Between the April 28th report and June 18, 2020, EY was completing the 2019 audit. The 2019 audit was the one in which EY sought to bypass the trustee and confirm the escrow balances directly with BDO Unibank and the Bank of the Philippine Islands. The audit firm initially received documents that purported to be confirmations from these banks. When EY sought to verify the authenticity of those documents directly with the banks responded that they had not issued the documents and that the accounts did not exist. On June 18, 2020, Wirecard issued an ad hoc disclosure to the market stating that the publication of its 2019 annual report would be delayed because the auditors had been unable to obtain sufficient audit evidence regarding cash balances on trustee accounts totaling approximately $1.9 billion. The disclosure stated that there were indications that spurious balance confirmations had been provided. The share price collapsed. From a closing price of approximately $104 on June 17, 2020, the shares fell to approximately $25 by June 19 and continued to decline thereafter. On June 19, 2020, Marcus Braun resigned as Chief Executive Officer. He was arrested by Munich prosecutors on June 27, released on bail, and subsequently re-arrested in July 2020 and held in custody pending trial. Jan Marsalek, the Chief Operating Officer who had supervised the third-party acquirer business, did not appear at scheduled meetings on June 18th and 19. Austrian aviation records subsequently obtained by investigative journalists and confirmed in reporting by Der Spiegel, Bellingcat and other outlets established that Marsalek had boarded a private aircraft at Bad Vöslau Aerodrome in Lower Austria on June 18th or 19th, with a flight plan filed for Minsk, Belarus. Marsalek's whereabouts have been the subject of subsequent international warrants and reporting, with various indications placing him in Russia. He remains, as of the record relevant to this episode, a fugitive. On June 20, 2020, Wirecard's management board acknowledged in a further disclosure that the $1.9 billion in trustee accounts likely did not exist. The company withdrew its previous financial statements for 2016, 2017, 2018, and the first quarter of 2019, stating that they could no longer be relied upon. On June 25, 2020, Wirecard AG filed for insolvency at the Munich District Court, citing impending insolvency and over-indebtedness. The filing was the first insolvency of a DAX-listed company in the history of the index. The criminal proceedings that followed were structured around the indictment filed by the Munich Public Prosecutor's Office. The principal trial, of Marcus Braun and two further defendants, commenced in December 2022 before the Munich Regional Court. The indictment charged commercial gang fraud, breach of trust, accounting manipulation, and market manipulation. The indictment alleged, and the prosecution sought to establish, that Braun had directed or knowingly participated in the fabrication of the TPA business. The defense position, as filed and reported, was that Braun himself had been deceived by Marsalek and a circle of subordinates, and that the fabricated balances had been concealed from the chief executive. The regulatory response in Germany was structural and extensive. The Federal Ministry of Finance commissioned an external review of BaFin. The Financial Reporting Enforcement Panel arrangement, under which listed company reporting review had been organized as a two-tier system with a private body performing the first-tier review, was abolished. BaFin was given direct authority for accounting enforcement on listed companies. The Bundestag Inquiry Committee, which sat for more than a year, produced a comprehensive report on the supervisory failures, the structure of the fraud, and the response of public institutions. EY, the audit firm, was the subject of multiple proceedings. The German auditor oversight body, the Abschlussprüfer Aufsichtsstelle, opened investigations. Civil litigation by Wirecard investors against EY proceeded in multiple jurisdictions. The firm itself stated publicly that it had been the victim of a sophisticated and elaborate fraud designed to deceive the auditors. The structural question of whether the audit procedures applied met the professional standard for the assertions being audited is one that the disciplinary and civil proceedings have addressed and continue to address on the public record. What the Wirecard case establishes at the structural level is a specific finding about the verification chain for reported cash held at third-party financial institutions in jurisdictions geographically and operationally remote from the auditor. The fraud did not exploit a complex financial instrument. There was no derivative structure, no off-balance sheet special purpose entity, no novel accounting interpretation. The fabricated asset was cash. Cash is the most basic line item on a balance sheet, and direct bank confirmation is the most basic audit procedure. The mechanism that sustained the fraud for approximately a decade was the interposition of a controlled intermediary, the trustee, between the auditor and the bank, combined with the geographical remoteness that made bypassing the intermediary operationally inconvenient. The structural finding is that the third-party acquirer arrangement as a business model creates an inherent verification problem when the acquirer is located in a jurisdiction where independent verification of underlying merchant flow is difficult, and where the processor's escrow claims are held through intermediated structures. The legitimate version of the model requires gatekeepers to perform verification that is operationally more demanding than the verification ordinarily applied to comparable balance sheet items. Where the gatekeepers do not perform that verification, the model is capable of supporting fabricated balances at a scale that materially distorts the financial statements of a listed company. The regulatory changes that followed the Wirecard collapse were concentrated in three areas. First, the German two-tier financial reporting enforcement system was replaced by direct BaFin authority. Second, the supervisory perimeter for technology companies with embedded financial activities was reviewed, with consequences for how holding companies controlling regulated subsidiaries are classified for consolidated supervision. Third, the auditor oversight regime in Germany was tightened, with expanded authority for the Abschlussprüferaufsichtsstelle and changes to the auditor rotation requirements for public interest entities. The European Securities and Markets Authority published a peer review of BaFin's response to the Wirecard situation, identifying specific deficiencies in the supervisory action and recommending changes to national competent authority practice across the European Union. The audit firm's role has been the subject of regulatory and civil proceedings in multiple jurisdictions, with findings that have addressed the adequacy of the procedures applied to the TPA escrow balances. The criminal proceedings against Marcus Braun and co-defendants are part of the public record. Jan Marsalek remains a fugitive subject to international warrants. The Insolvency Administration of Wirecard AG continues to recover and distribute such assets as exist. The forensic finding is this: a balance of approximately $1.9 billion was reported on the consolidated balance sheet of a DAX 30 company for a period of years and confirmed by audit during that period. That balance did not exist. The verification chain that ordinarily confirms cash balances was interrupted by an intermediary whose role was not subjected to the scrutiny that the materiality of the asset warranted. The intermediary was located in a jurisdiction geographically and operationally remote from the auditor, the supervisor, and the analyst community. The detection function was performed before the formal verification chain detected anything by investigative journalism and short-selling research. The formal verification chain detected the fraud when, and only when, the auditor pursued direct independent confirmation through a channel not controlled by the intermediary. The Wirecard case is, on the public record, a case in which the simplest audit procedure applied to the most basic balance sheet item would have produced detection at any point during the fraud's operational life. The procedure was not applied until June 2020. When it was applied, the fraud collapsed within a week.